all of you here for this conference. Let's get right to work. We meet in the midst of the longest economic expansion in our history, and an economic transformation as profound as that led us into the Industrial Revolution. From small businesses to factory floors to villages half a world away, the information revolution is changing the way people work, learn, live, relate to each other and the rest of the world. It has also clearly changed the role of government and how it operates. This conference is designed to focus on the big issues of the new economy. How do we keep this expansion going? How do we extend its benefits to those still left behind in its shadows? What could go wrong, and how do we avoid it? That's what I hope this conference will be about. The roots of this meeting stretch back to our first economic conference in December of 1992 in Little Rock, shortly after I was elected president. Then some of the leading minds from around the country and across the economic spectrum addressed a challenge that to all Americans was immediate and clear. Unemployment was high, interest rates were high, the deficit was exploding, the debt had quadrupled, even an apparent recovery was generating no jobs, and inequality had been increasing for well over a decade. Thanks to a strategy designed to bring down the deficit and convert it into surpluses, to expand trade, to invest in education, training, and technology, and to establish conditions in which the new economy could flourish, especially in the Telecommunications Act, which was passed about 4 years ago now. The American people, American entrepreneurs, have given us a remarkable recovery. The performance of the new economy has been powered by technology, driven by ideas, rooted in innovation and enterprise. It has opened doors of opportunity and challenged our very understanding of economics. I remember sitting around a table in Little Rock in 1992 asking my economic advisors how low unemployment could get without triggering inflation. The consensus was somewhere between 5.5% and 6%. Now bear in mind, these were people who were philosophically committed to low unemployment and were willing to resolve doubts in favor of it. No one believed then we could have 4% unemployment on a sustained basis without inflation. No one believed that this economy could generate productivity rates of more than 2% a year on a consistent basis. Now we're nearly at 3%. There is no single answer about how this happened. I think clearly the nature of the new economy and the strength of the American entrepreneurial system led the way. The fact that many of our traditional industries and workers increased their productivity played a role. I also believe the government's commitment to fiscal discipline, to expanded trade, to investment in people and technology, and to cutting-edge research, and again, I say to establishing the conditions in which the new economy could flourish, played a large role as well. Now, one of the things that I think is important to focus on is just some basic facts. Information technology today represents only 10% of American jobs, but is responsible for about 30% of our economic growth. It accounts now for about half of business investment. And just as Henry Ford's mass-produced cars and the assembly line itself had broad spillover effects on the productivity of the American economy, these new technologies are doing the same thing, rifling through every sector of our economy, increasing the power of American firms and individuals to share broadly in its prosperity. Today, information technologies allow industries to recognize instantaneously changes in demand and to manage their inventories more efficiently and quickly. They are speeding the development of new products to market. Supercomputers, for example, have helped Detroit automakers cut the development times of new cars by half or more. They've helped pharmaceutical companies cut down the development of new the development time for new anti-cancer drugs by several years. Clearly, they will have a profound effect, information technologies, in the biomedical sciences in the 21st century. As we see by the simple fact that in the next few weeks we will announce for the first time the complete sequencing of the human genome, something that would have been literally impossible without information technology. And of course, just contemplating the potential impact of nanotechnology on the biological sciences alone staggers the imagination. Information technology clearly is also creating a lot of more mundane opportunities in e-commerce for traditional businesses as well as the dot-com companies. And business-to-business e-commerce is growing even faster than business-to-customer commerce. In 3 years, it may reach a staggering $1.3 trillion in the United States alone. We know all of this is just the beginning. So now we want to share the best ideas and ask the right questions. Economists, for example, like to talk about speed limits for the economy. Do we have higher speed limits today? Do they exist anymore? How do we measure the impact of technology in this economy? What will be the sources of tomorrow's growth? We know when it comes to education that the right teacher and the right computer can give a student in the poorest neighborhood the same access to every library and every source of information as a student in the most privileged private school. But those who are left out will be left further behind. How do we close the digital divide? Can poor areas in the United States and entire developing nations leapfrog an entire stage of development, jumping ahead to cutting-edge technologies, avoiding not only the time it takes to go through the industrial economy, but also the unpleasant side effects, particularly of pollution and global warming? How can we best make that happen? How important is information technology relative to other pressing needs of developing nations, such as health or education or improving agricultural productivity? Or do they go hand in hand? Technology can allow nations to grow their economy without harming the environment. How do we convince people around the world, and even in the United States, that this is true? I believe the computer and the internet give us a chance to move more people out of poverty more quickly than at any time in all of human history. I believe we can harness the power of the new economy to help people everywhere fulfill their dreams. On my recent trip to South Asia, I saw the beginnings, just the beginnings, of that potential. But it is clear that none of our hopes for the new economy, which are really hopes for a better society, one in which we are brought together, not driven apart, one in which we sustain our earth, not exploit it, one in which we lift up the poor as well as those of us who are better off, that these developments will not just happen. They too will take new ideas, new initiatives, new innovation, the kind of thing that so many of you have done for so many years now. I thank you for being here. I thank you for being part of this dialogue. And I'd like to get started. Our first panel discussion is entitled, "Is the New Economy Rewriting the Rules on Productivity and the Business Cycle?" And I'd like to ask Abby Joseph Cohen, Chair of the Investment Policy Committee at Goldman Sachs, to begin. Thank you very much.
Mr. President, thank you very much on behalf of all of us for this opportunity to come together in Washington and discuss these very important issues. As the first speaker on this panelist, I feel something of an obligation to set a framework. Many of you know that my day job is as a stock market strategist. And for the past decade, we have been enthusiastic about the outlook for U.S. stock prices in the United States, and we remain so. Over the last 10 years, the U.S. stock market has been propelled primarily by dramatic improvements in the U.S. economy. And of course, the starting point in the early part of the 1990s was a stock market that was highly skeptical and cynical, a stock market that looked at the lowest profit margins that the U.S. corporate sector had generated in more than 2 decades, a stock market that looked at the largest budget deficit the United States had ever experienced, and a stock market that displayed that skepticism through stock prices that were perhaps 50% below where they should have been at that time. Over the last 10 years, this economy has been blessed, I believe, by improvements in 2 broad categories. Number 1, solid economic policy, and secondly, an improvement in the behavior of U.S. corporations. With regard to economic policy, the financial markets have benefited from so many aspects of policy, it's hard for me to list them, but briefly let us consider first the improvement in fiscal policy, where we went from a budget deficit equal to 6% of our GDP to one where we now have a surplus. On monetary policy, we have had a Federal Reserve that has focused on elongating this economic expansion and has also emphasized appropriate regulation of our banking institutions. We also have a nation that has promoted free trade, and when you are the world's most competitive nation in so many of these important new areas of growth, what we should be supporting is free trade. In addition, we've had an improvement as it relates to the openness of information. Our corporations, for example, are required to provide more disclosure and more transparency, and we have moved in that direction. And if I could sound a slightly bittersweet note, we have not done an equally good job as it relates to government economic data. In many ways, our government data collection has fallen behind. As the economy has become more complex, as it has moved forward into the digital age, we have not fully reflected that in our own data collection. There is a second broad area in which I think our nation has been blessed, and that has been the improvement in business behavior as well. Over the last decade, we have seen a surge in research and development. We have seen a surge in capital spending, loosely defined because it's no longer just buildings and equipment. It's also computer software and applications. But let's keep in mind that the decade of the 90s can be loosely broken into 2 parts. And in the first part of the 1990s, things didn't look so good and they didn't feel very good for many of our workers. Corporations were cleaning the slate. They tried to boost profit margins by identifying those areas in which perhaps they were not very good, areas in which profit margins were poor. These areas were restructured, they were downsized, they were eliminated. And while that did have an impact on those individual companies, the impact on the macroeconomy was not so favorable because job creation suffered as a consequence. But over the last several years, let's say since the end of 1994 or 1995, there has been a major point of inflection. While many of our corporations are still restructuring, they're still downsizing, as a nation, we have moved towards significant job creation. And if the United States economic performance of the late 1990s is contrasted to that of any major industrial nation, perhaps the single biggest difference has to do with how we have done in labor markets. Over the last 5 years, the United States, on a net basis, has created 16 million new jobs. And that is after we net out or subtract out the jobs that have been lost through downsizing. And 2/3 of these new jobs pay above the median wage. If we contrast this to Europe, for example, a community that has a GDP larger than that of the United States and a population larger than that of the United States, their net job creation has been -1 million during the same period of time. And so when we think back as to why the financial markets have responded in a favorable way, they've done so, we believe, appropriately. This economy has gotten not just bigger, but also better. Not only have profit margins improved, but we've done an increasingly good job in terms of creating jobs and boosting incomes. Now, when we think about what might go wrong, let me suggest to you the following. There's much discussion about a new economy. Let's keep in mind this is not the first time this has happened. If you go back over the last century, there are at least two other occasions when the economy was transformed sufficiently that there was much discussion then about a new economy as well. Toward the end of the 19th century, the United States shifted from an agrarian-based economy to one that was industrially based. And as a consequence, labor productivity rose, the standard of living increased. We saw a similar change at the end of the Second World War when the U.S. industrial economy became far more sophisticated. And again, productivity increased, the standard of living rose. And those two previous occasions in our economic history had one thing in common that distinguishes them thus far from the current period, and that was a change in government policy towards education. At the end of the 19th century, many of our state and local governments decided it was in their own best interest to have a large group of literate workers, and we provided free public education for the first time. The consequences and results were very clear and very positive. At the end of the Second World War, there was yet another shift in public policy towards education. Think of the GI Bill of Rights, which ensured a government education to anyone who had served in the armed forces. Think as well about the incredible surge in public spending in the public university systems through so many states of our great nation. In these two other opportunities in economic history, we as a nation stood up and provided the education so that all of our workers could participate in the new jobs that were being created and in the new economies that were developing at that time. And I would suggest that that remains our greatest challenge in the coming years. Mr. President, thank you.
Thank you very much.
Roger?
I was thinking of ways I could make the biggest impact here this morning, and it occurred to me that if I could get Abby to tell me what her views on today's markets might be, I could just announce them and leave my own comments at that, but she turned me down. My message this morning is that we are in a new economy which is beginning to rewrite the business and economic rules, but that it's still very early to conclude that they will be entirely rewritten. And I want to make 5 basic points. The first is, to what degree are we in a new economy? And if one defines that as an internet-driven one, I think the answer is that we are moving rapidly into that, but that the conversion is not as far along as the financial markets and the financial press would suggest. Electronic commerce totaled about $150 billion last year. That's in the context of a $9 trillion economy. So that ratio is still a small one. But that e-commerce base is expected to grow about 85% a year over the next 4 years. It'll get to about $2 trillion on that basis. And obviously, it will get to a much more significant share of total economic activity in this country. But in other words, we're still in the early stages of converting to a new economy. Second of all, is this conversion fundamentally changing the productivity growth rate of the economy? And let's remind ourselves of the importance of productivity growth. It's the primary driver of living standards. Over the long term, productivity growth and real wage growth have to equalize. And so the growth of real wages determines the rate at which standards of living rise. It's too soon to conclude that the higher productivity growth rates we've seen over the past 3 years will persist over the very long term. But we certainly are witnessing a resurgence now. I was reminded yesterday that over the 4 years ended 1996, productivity growth averaged a little less than 1% annual rate. Over the past 3 years, that's tripled to about 2.7%. That's probably attributable to the stunning rate of U.S. technology investment during that past decade, because business fixed investment grew about 10% a year through '98. That's 3 times the economic growth rate over that period. Much of that went into computers and related equipment. and the results on productivity are probably quite connected there. But we don't yet know whether our higher productivity growth rates will continue. Over 40 years, we've had surges like this before, and the long-term productivity trend line has not turned up. So whether this is just another periodic surge, Mr. President, or whether we've entered a new age, at least in regard to productivity growth, isn't yet clear. Thirdly, the growth capacity of the economy itself. As long as this productivity growth differential persists, the U.S. can sustain a higher economic growth rate without incurring higher inflation. If we add, for example, the recent 2.7 productivity growth rate I mentioned to a 1% labor force growth, then the growth capacity of the economy would approximate 3.5% or a bit higher. And that's the rate, indeed, which the Federal Reserve System is projecting, for instance, for this year. That's also twice the growth rate of the 20-year period ending in the middle of this decade. Of course, the U.S. economy recently has grown at even higher rates than that, including the amazing 7% plus figure for the last quarter. And because the Federal Reserve Board considers such above potential rates, coupled with the current 4% unemployment rate, to be inflationary, that's why it's been steadily tightening monetary policy. Fourth, a word about the business cycle. As Alan Greenspan is fond of saying, and I agree, it has not been repealed. The pool of workers available and willing to find new work has become smaller and smaller, and unless demand cools, there's a limit to that labor shrinkage. And at some point, that will push up wage rates, and we still do risk, the old syndrome of tighter money and economic contraction. But the cyclicality of our economy certainly has moderated. We see it in the unprecedented length of this expansion phase of economic performance, which reflects, in my view, particularly the highest services share of the economy, improved methods of controlling inventory levels, and a more sophisticated and more effective monetary policy. But at the moment, there are not yet signs of the imbalances which typically signal incipient inflation. And on that basis, this expansion should continue nicely, particularly since the remarkable budget surpluses have been dampening what otherwise would be a greater excess of demand over potential supply, and they also have helped to finance the investment boom that I referred to. And I do want to pay tribute to President Clinton for having led the nation into this previously unthinkable fiscal heaven. Those of us that remember the early days and all the forecasts that were then around, if you'd counted up 1,000 of them, you wouldn't have found one that would have projected surpluses at all, let alone this magnitude of surpluses. Finally, a financial market perspective. And that may be particularly apt after yesterday's seismic market performance. There's going to be a correction. It's probably going to be a sharp one, at least in terms of technology equity values. Not all companies will be affected. The Intels, Ciscos, and Microsofts should be less affected. But we are already seeing all of the preliminary signs of that type of correction. And there's nothing new at all about the idea of such a correction. It's rather a classic flight to quality that you've seen in many markets over decades. But should such a shakeout occur, my point here is that it does not signal that we're not in such a new economy after all, nor that the higher growth potential and the milder business cycle effects are less likely. We've experienced a historically anomalous period of high equity returns, particularly in the tech sector. And as Abby Cohen says, or said a few days ago, the reassertion of historical rates of return is probably at hand. So to close where I started, We're in the beginning phases of a new economy, which is beginning to rewrite the rules of business and economic growth and cyclicality, but it's still early days. Thank you.
Professor Galbraith?
Mr. President, the question before this panel is, in effect, can full employment without inflation endure? According to the old rules and those who believe them, the expansion will not last. Growth is too rapid, unemployment too low, stocks too high. There are deep and somewhat mysterious reasons why wage inflation is sure to explode someday soon. Even more mysteriously, some have even suggested that the rate of productivity growth is too fast. A second view holds that the new economy has changed the rules, cutting costs and creating opportunities that never existed before. In part, this is surely correct. The new technologies are today contributing 8% of employment and about 35% of growth, the Commerce Department reports. They are important, but they are not the whole story. The third position is that the old rules were wrong all along. This viewpoint, which I hold, is that for the first time in 30 years, we are now seeing the fruits of full employment. Many economists have lived for decades in fear of full employment. They imagined hidden terrors like runaway inflation. They did not sufficiently listen to those few, like the great Robert Eisner, your friend and mine, who taught that the real rules weren't so grim. Eisner did believe that growth could raise wages and yet also spur investment and productivity. In effect, that full employment in the old economy would bring the new economy to life. Mr. President, the historic merit of your administration and also of Mr. Greenspan's tenure at the Federal Reserve was to put this proposition to the test. And now we know. In every year since 1993, unemployment has fallen, and real growth has regularly exceeded speed limits widely announced in advance. In almost every year, productivity has accelerated. Now we know. Many also fret that today's prosperity was purchased by high inequality, and particularly the information technologies are inequality producers. But in fact, since unemployment fell below 6%, pay gaps have narrowed. Improvements so far are modest, but the movement is in the right direction. Today, we know, therefore, that rising pay inequalities are not a price of progress, nor are they a social cost of full employment. Let us therefore set aside shop-worn worries and the self-immolating doctrine of the preemptive strike. If there is a ceiling for growth, or a floor for unemployment, or a limit to this expansion, the truth is that no one knows where they are. Why borrow trouble? Why not take a positive view? Full employment and strong growth are great achievements. Let us celebrate and defend them. Let no one say that the unemployment rate is too low, and especially let no one say that the productivity growth rate is too high. Are there dangers? Yes, I believe there are. Inflation, apart from oil prices, is not one of them. High interest rates are a danger. American households, I believe, have too much debt. They will become vulnerable when interest rates rise. Stock market speculation is, I believe, a danger. Margin lending especially has been exploding, and those loans are being exposed as stock prices decline. In my view, and here I have to say I probably stand alone on this panel, there is also a risk of overdoing the budget surplus. This is what economists used to call fiscal drag. I could be proved wrong on this. It would not be the first time. But for this reason, for fear that overdoing the budget surplus might slow the economy, I do not favor rapid reduction of the public debt as an economic objective for its own sake. Can these dangers be managed? Yes, they can. We can offset household debt burdens and the declining personal savings rate by raising wages and family incomes. We should raise the minimum wage, expand the earned income tax credit as proposed, and support collective bargaining. On average, earnings should keep pace with productivity, a bit more at the bottom, a bit less at the top. We should also modestly expand public services, education, health care, and the environment, especially as we can surely afford to do. For its part, And instead of setting off to fight an inflation that is the pure product of academic imaginations, the Federal Reserve could act on margin lending. Raising margin requirements is the direct approach to a stock bubble, more targeted than raising interest rates and more effective than jawboning the lenders. Should a crash come, sooner or later, a failure to have acted on margins will weigh on the record, and it would not be for the first time. But a crash need not come. Despite the nervousness of the markets, these are good times. They're very good times. With the right leadership, with prudent policy changes when they are needed, with cooperation from all branches of government, they can endure. We can continue to grow and prosper, to enjoy full employment, strong productivity growth, and a rapidly expanding new economy. Not forever, perhaps, but for years into the future, another 4, another 8, yes, we can do that, and we should. Thank you very much.
Thank you. I promised myself I wasn't going to inject myself into this until we heard from everybody, but I just want to throw out 2 or 3 questions because I want to get, after we hear from the panelists, and I want Secretary Summers and our CEA Chair Martin Bailey to say a few words, and then I want to have some questions. But just all of you have raised a couple of issues. Let me just ask you to think about this, everybody. On this question of the business cycle, we've had, since the Second World War and before the information technology revolution, generally a trend of longer expansions and shorter recessions. So that's presumably the product of generally better economic management. Is there something inherent in the technology revolution, as Professor Romer at Stanford and others have argued, that basically, if it doesn't repeal the business cycles, makes them far more elastic even than better economic management would warrant? The second thing I think is worth questioning is, have we avoided inflation due to wage demands because workers are smarter than they used to be and they understand that they're in a global economy and they can't ask for more than their company's profits will warrant? And the third thing I wanted to just ask you to think about, since I was hoping Professor Galbraith would raise this question of whether I was making a mistake to try to get us out of debt, because some of my good friends have accused me of practicing Calvin Coolidge economics. And let me tell you what my reasoning is, and I just want you all to think about this, because I'm prepared to have somebody say I'm wrong about this. The reason that I wanted to continue to pay down the public debt is that private debt in this country is so high, both individual and business debt, and I worry in the same way you do about that coming down not only on individual firms and families, but also on the economy as a whole. So I figured what really matters is the aggregate savings rate or the aggregate debt to wealth ratio. And if I keep bringing down the public debt, we could keep interest rates down and at least lengthen the time between now and some darker reckoning on that. So the reason that I always thought it was important to pay down the public debt once we got into surplus is that private borrowing is so high in this country. And the debt-to-wealth ratio is not bad at all because of the value of the markets, but still the individual and firm debts are quite high. So I was trying to get the aggregate balance right, and that's been my logic all along, and why I think it's different from previous times when I admit the government's been in surplus when it should not have been. Professor Norton.
Thank you very much. Mr. President, it's an honor to participate in this discussion on the shape of the new economy. Now, I should say in my day job, I'm a teacher. And in that role, my students often ask just the questions you've raised. And here's what I tell them. First, they often ask, are we in a new economy? And I say definitely yes. It's a new economy that's changing the numbers, but it's not rewriting the rule book. Now, like most major economic revolutions in the past, it's centered in a specific area or technology. And in particular, in this case, as people have discussed, it's in information technology. And that means computer hardware, software, and communications. The most visible part of that to us is the internet, but it's my view that the real, which is like the tip of the iceberg, but my view is the really important part is going on under the surface where it's less visible in the business areas, old-fashioned things like better scheduling and inventory control and new era type activities like improved price discovery and online auctions. But I think it's a real change in our economy. Second question, can we see the new economy in our economic performance? And here again, the answer is definitely yes. Many members of the panel have alluded to what I think of the dark ages of productivity, which was after the 1970s oil shocks up until, say, the beginning of the 1990s, in which productivity grew hardly at all. But in the late 1990s, the U.S. has enjoyed a remarkable improvement in its productivity growth. A number of earlier speakers mentioned this. Since 1995, productivity growth has grown at almost 3% a year. And the broadest measure of productivity growth, known as multi-factor productivity, has actually tripled since the period of the 1970s and 1980s. A very close look at this record indicates that this productivity boom is largely centered in this information technology part of the economy: computers, microprocessors, software, and communications. And I might say one question is, well, didn't this happen before? Railroads, televisions, highways, things like that. The fact is that there's no time in recorded economic history have we seen the price and productivity movements in computers. It's absolutely unprecedented on economic record. A more controversial question is how widespread is the information technology revolution, and there's a big debate here. My reading of the evidence is that most of the productivity rebound is due to the production and use of information technology in these three big sectors I mentioned. There's some modest increase outside information technology, but up to now it's relatively modest, and part of it may be due to the strong business cycle. So in terms of your question about speed limits, I think it's pretty clear the speed limits have been raised. The overall long-term speed limit for the economy, we used to think about 2.5%. It's now somewhere in the 3 to 3.5% per year range. We don't know exactly what it is or how long it will last, but it's pretty clearly higher than we thought it was. Now, the productivity rebound is part and parcel of the remarkable economic recovery that we've enjoyed over the 1990s. It's kept price and wage growth down and allowed the long economic expansion to continue. And it's been not just by itself, though, because it's been combined with a prudent fiscal policy, not overdoing it in my mind, plus an intelligent and somewhat gutsy monetary policy. And this has brought good jobs to an increasingly large number of Americans. And I'd agree with what Jamie Galbraith said. A good job market, a strong job market, and a low unemployment rate is the most progressive social program that we know. Now, third question, are there any clouds on the horizon? Well, you know, for economists, there never is a sunny day. So I'd just mention two clouds that I see. First, even though inflation has been well behaved, it seems unlikely that we can continue the current growth rate without rising inflation. The speed limit has been raised, but there's still a speed limit. And we don't know when or where or how the economy will slow down, but I think the betting odds are long against another 4 years as strong as the last 4 years. And second, I'd like to echo the remarks of a number of the panel. It's my view that the current level of stock prices is not only unrealistically high, but I think it's also economically damaging. Inflated asset values make people feel wealthier than they are, and they reduce national saving. And I think that's one reason, and I agree with what you just said, Mr. President, one of the important reasons, and they increase inequality. They make us feel good, and overvalued markets make us feel good, but they're not healthy for us. So in summary, my view is the new economy is real and it's impressive, but we can't let it cloud our judgment. I believe the history books will record that the Clinton-Greenspan team, helped to be sure by the favorable winds of fortune, has presided over one of the most successful periods of American economic history. But even the fastest computers can't tear up the rule book and repeal the need for continued fiscal discipline, alert monetary policy, and realistic expectations about future prospects. Thank you.
Kim? We thought we ought to have one of the actors in the new economy here in this panel.
Thank you very much. I'm delighted and honored to be here this morning. Briefly, by way of introduction, I co-founded Marimba about 4 years ago with 3 other members of the Sun Microsystems Java team. And Marimba sells internet infrastructure software to companies like Schwab and Home Depot and General Motors and NASDAQ and many others. We employ about 200 people. We have offices throughout the U.S. and we sell our products worldwide. So like many companies in Silicon Valley, we've had to scale very quickly. I think perhaps we're a little unusual in that, however, we have real revenues. We were actually cash flow positive last year. And in fact, we may be in danger of turning profitable this year. So that's a bit of an anomaly. I'd like to briefly share a few of my observations on the topic of the new economy from the perspective of a Silicon Valley entrepreneur. And I actually think I perhaps come with 2 vantage points. One is being the CEO of a pre-IPO and now post-IPO company in Silicon Valley. The other perspective is that of working with the chief information officers of some of the largest companies in the world, companies that are really radically changing their businesses to adopt to the internet and taking some very bold risks, and that's been fascinating to see and be a part of. 3 main thoughts came to mind when I considered the topic of the panel today. First, I believe that we've barely begun to feel the real impact that the internet will have on our economy. We're still really in the startup phase of this thing. I think we're maybe barely 10% into it, if that. Most businesses that we work with are just beginning to adopt these new technologies to achieve new efficiencies in their businesses, and we really, again, haven't seen the impact yet on the economy. And furthermore, while most of the attention has been on the dot-coms, I think the really exciting changes are happening in the bricks and mortar companies, which are just now beginning to adopt the new technologies, creating these trading exchanges to make logistics and supply chains more efficient. They'll have huge advantages in scale, and again, that impact has not yet been seen. So when it comes to the new economy, I really believe we're at the point of departure, not at the point of arrival. My second observation is that the new economy is really less about a revolution in technology or economic policies or accounting principles, and it's really more about a change in attitude. Certainly, internet efficiencies are causing inventories to vanish. They're creating these transparent markets, which are driving prices down, all of which is resulting in greater productivity, the impact of which we probably haven't even created the tools yet to fully measure. But to me, the really exciting changes are the fundamental shifts in human behavior that we're seeing. For example, the way things get done at my company, I think, is very different from how an old industrial economy company might have worked. Certainly, we give stock options to everyone, not just the executives. Everyone has a piece of the company, and that means ownership. And that means top performance, and that's what results when people have skin in the game. Another big change in behavior is the willingness to partner. The fact that many companies, certainly ourselves, and again, now even the bricks and mortars companies are partnering very aggressively, even with competitors, reaching out from not a position of weakness, but rather a position of combined strength. Another change is recognizing that great ideas can come from anywhere in an organization, and a real trend towards seeking out the best ideas regardless of whose they are. And we're also seeing companies adopt the policy of creating small teams that go out and figure out the next great idea or solve the new problems. That's how Java happened. That's how, in fact, at Marimba, we have an advanced development team, believe it or not, that tries to figure out what the next development might be and what our competitors are doing. So we have to stay one step ahead of the competition, and teams are a very important part of that. And finally, another big change I'm seeing is the willingness to take risks. Certainly we have to as a company, and our customers are as well. And that means willingness to make mistakes, but then very quickly correct course, make course adjustments, and admit to mistakes, and then fix problems. And that's really a change that I think is fundamentally radical for these large companies. It's less about a 5-year plan or a 3-year plan. It's more about a 1-month plan. You still have a long-term vision, but you have to be constantly adjusting your course to get there and willing to do so. So again, it's about a change in behavior, and that's what I think the most profound changes we're seeing. My third and final observation is that the new economy is not fleeting or ephemeral. This is a sustainable economy. It's a sustainable situation. And as has been observed on the panel thus far, certainly the key drivers here have changed for good. For example, the shift from physical assets to being a knowledge-based economy, the fundamentals of pricing and distribution, all of those things have changed. I think a lot of the attention on the new economy has been focused on the pop in the stock market, and I think it's sort of seductive perhaps to focus on the run-up in stocks and the IPOs and so forth. But to me, new economy or old, success is still about building sustainable businesses that deliver innovative products that change people's lives for the better and that return real value for shareholders, and that still matters in the new economy. Profits still matter. And so do the hallmarks of so-called old economy companies, things like hard work and commitment, trust, real results. All this stuff might sound maybe a little old-fashioned, but that's what matters to us at my company, and I think it's a view that's actually shared by many in Silicon Valley. I think at the end of the day, what really matters is how we put this wonderful new technology to work to change the human condition for the better. And I think we have some huge challenges ahead of us, as has been noted. Education is one. Access to this technology is another for all, and shortage of talent. I think our generation has an incredible responsibility to get this thing right. And when it comes to the impact of the new economy, to me, that would be the greatest achievement of all. Thank you.
Thank you. They did a great job, didn't they? Let's give them all a hand. I would like now to ask Secretary Summers and our CEA Chairman Martin Bailey to make a few brief remarks, and then I will open to the audience and the panel for discussion. Larry? Thank you.
Mr. President, what a different world it is than when I first had the chance to meet you in Little Rock in 1992, and we discussed whether unemployment could be reduced below 6%. We discussed whether the deficit could be reduced below $200 billion. We discussed whether the United States would have any prospect of competing with Japan and Europe during the 1990s. I think there are many aspects of all of this, but I would just highlight 4 themes that came out of the discussion that we've just heard. The first is that the new economy is new, but has to be built on old virtues. For us in government, that means respect for markets, and it means paying down debt and increasing savings. However important that used to be, increasing national savings and paying down debt becomes much more important when we have the staggering high-quality investment opportunities that we have today. It becomes more important to take savings out of the sterile asset of government paper and put them to work in these new investments. Second, we have to manage what the Vice President likes to call this information technology supply shock. In the 1970s, we had a key input to the rest of the economy go way up in price, and everything bad happened. Inflation went up, unemployment went up, productivity growth went down. We had what people called stagflation. Today, we've had a key input go way down in price, and we've seen the reverse. Inflation down, unemployment down, productivity way up. Somebody needs to coin a term for the opposite of stagflation, but we have to work to maintain and harness this information technology supply shock. Third, in an economy where jobs are looking for people as much as people are looking for jobs, social policies become economic policies. Helping people get from welfare to work, helping those with disabilities to take their part in the workplace, creating family-friendly workplaces so more moms are able to work. These were always important social issues. In an economy where a key bottleneck is the supply of labor, something we all ought to be able to agree on is the importance of expanding that effective supply of labor, and that makes these social policies all the more important. And the fourth point that I would highlight, and in some ways it may be the most important because it's forward-looking, is that we can be proud but should never be satisfied or complacent. That is, I think, important in two respects. One, we need to think about having that circle of prosperity be as wide as we can, and we in this country have to worry about those who have been left behind in this country, and we have to worry about our role in the world. And the vote on China in the next several months will be a crucial test of our country's internationalist sentiment. But we also need to avoid complacency in a different sense. As satisfying as the remarkable progress that we have made is, I think we all need to maintain an awareness that the risks and uncertainties of economic life continue, and that the old virtues on which a new economy is built need to include prudence, need to include recognition of risk, and need to include hard-headed realism in the formation of any and all spending, borrowing, or investment plans. If we can keep our focus on those things, the new economy can work well for all our citizens.
That's good. Martin?
Thank you. It's a privilege to be here. One of the things that is helpful in having this conference is that at the Council of Economic Advisors, along with other members of the economic team, we're responsible for making the economic forecast. And this is a time of very great, I think, uncertainty, very great difficulty to make 10-year projections or even the kind of longer-term projections that are needed for Social Security and Medicare planning. I was instructed by the panel, but I guess they didn't come down in quite one place. I guess Jamie Galbraith is sort of the let it rip philosophy, and other members of the panel pointed to the fact that speed limits may have increased, but they're still there, and I think that means they still have to be taken into account in the forecasts that we make. So as we look at our forecast, I think we have to bear in mind both the optimism that's justified by this new economy, but the importance maybe of not letting that optimism go to our heads as we recognize the uncertainty going forward. I'm going to give way to a little more of the optimistic side of myself in the other comments that I'm going to make. We've talked about this new economy. But it really is striking if you make a comparison of this expansion to earlier expansions that there are some striking differences. Of course, previous expansions, by the time they got to this point, they were all already dead. So there's one obvious difference between this one and the earlier ones. But perhaps more amazing is this expansion doesn't even look geriatric. It doesn't look like it's getting old. In the past, as past expansions matured, investment slowed, R&D spending slowed, capacity got strained, core inflation started to rise, and productivity growth slowed. In this expansion, there are really none of these telltale signs of aging are visible. And most striking, has been referred to several times, is the actual rapid growth and even slight acceleration in productivity growth that we've seen. So what's different about this expansion? I agree with the President and with Secretary Summers on the importance of paying down the debt, not only for the future, but I think it's been an important part of the success that we've had and why this expansion looks so young. The paying down, the reduction of the deficit, the shift to surplus, the beginning of paying down the debt, has helped make room for the investment which has contributed to this productivity-led expansion. In terms of it continuing and looking at the danger signs, I'm encouraged to hear, and I agree with the sentiment that's been expressed, that this technology has a ways to run, that we really haven't exhausted the potential of information technology. In fact, many of its changes are really in their infancy, and we're going to see those benefits coming forward. I think the next thing I'd say about what's different about this expansion, and Jamie Galbraith referred to it, is that it is the beginning of a sign that we're getting more equal growth. From the period from 73 to 93, not only did we have slow growth, but it was very unequal. We had a substantial rise in inequality. Over the 5 years from 93 to 98, and it is a short period, we've had broad income growth. Family income across all income groups has grown about 2%. And I think there's some lessons from that. First is that technology itself has sometimes been blamed for the rise in inequality. It has somehow been a force separating us. And yet in this period of rapid technological change, we've been able to combine that with more equal growth. So technology need not be always the enemy of more equality. And one reason for that has been mentioned also, and that is that we've had not only fast technological change, but a full employment economy, so that people have been out looking for workers, have been training those workers, and that has helped bring the people at the bottom up. But I'd also mention perhaps, and I'd be interested in the discussion of this, maybe the technology itself has become a bit more user-friendly, so it can spread to a broader group in the workforce, and they can get the benefits from it. Finally, let me say that if this is a new economy, if this is a new era of productivity growth, let's make sure, as Secretary Summers says, that we have the policies that move this down throughout the workforce. We need to make sure that workers at every level are given opportunities, that firms are encouraged to do the training that they need to do, and they're supported by education and training programs. We think there are real structural changes going on in this economy in the way businesses compete, in the way they structure their own workforces. We need to make sure that workers adapt and have the ability to adapt to this change that's taking place on the business side. I think the policies that are being encouraged, the training programs, the EITC, these are exactly the kind of things to make sure that the technological, the stuff that's coming on at this level also comes down to the people at the bottom and gives them the skills and the incomes that they need. Thank you.
Thank you very much. Anybody in the audience like to make a comment or ask a question of any of our panelists? Yes, ma'am. If you could stand and identify yourselves, and then I'll just move around the room the best I can.
Esther Dyson. I think I actually have a word for Larry, and it's stockflation. My question is, if you talk about the privatization of debt, we've also in some sense got privatization of the management of the money supply when people like Goldman Sachs, thank you, Abby, are issuing IPOs all over the place. And I remember learning about M1, M2, et cetera. It's not just assets somehow, it's moving into the income supply. People are being paid in stock. What's the impact of that on the economy?
I think there are several people at this table who might like to respond. Let me make just a couple of points, Esther. First of all, yes, we have indeed seen a very active equity issuance calendar. Let's keep in mind that it has a different flavor in this economic cycle than in previous ones. In earlier economic cycles, equity issuance was often dominated by secondary issuance, that is, new stock being offered by older companies. And they were often very large companies, and we often got to the point where gross issuance could be as much as 3 or 4% of market capitalization. What we have today are many more issuers, but the relative amount of equity that each one is issuing is far smaller. And we see that gross equity issuance in aggregate